In this lecture, we're going to explore one of the most important and famous models in the entire history of macroeconomics, a model which sheds light on some key fundamental features about economic growth and indeed helps clarify for us what we even mean by economic growth. Before we do that, let's just recap what we learnt from our previous lecture. The very important implication about how the path to economic growth can be different for different economies depending on their starting point. For economies with a low capital labour ratio, then it's possible to obtain a relatively large increase in per capita income through growing the capital labour ratio. But diminishing marginal productivity means that that's not necessarily appropriate for an economy that's beginning with an already high capital labour ratio. There, the path to further increases in per capita income will be total factor productivity. These themes will actually be important as we develop this particular model of economic growth. Now, the model of economic growth we're going to outline is known by various names, sometimes the Solow growth model, sometimes the Solow-Swan growth model, sometimes the neoclassical growth model. And if you search the economics literature or look at various textbooks, you'll find that either of those three terms are used. I prefer the name the Solow-Swan growth model, and that's how I'll refer to it in this course, because it reminds us of the two scholars who developed this model. Robert Solow, one of the most famous and eminent economists that there's ever been, associated with MIT, and an Australian economist, Trevor Swan, who was based at the Australian National University. It's interesting that in the development of this model, neither of these two scholars actually collaborated. They were working entirely independently, pretty much at the same time, trying to answer the same question: what is the nature of the economic growth process and what fundamentally matters for that process, and came up with pretty much the same mode of analysis. It's quite a remarkable coincidence. It's not one that happens very often, but it's something I think we should recognise in labelling this particular way of thinking about economic growth, the Solow-Swan model. The model, as you'll see, picks up on a lot of the themes we've already been exploring, and it's remarkable because of its simplicity. It's a beautifully elegant model. It's elegant in how simple it is, how it just builds on some key foundation principles in economics, principles we've already explored. But it's famous because of a very surprising prediction that this model yields. It's a prediction that says the following: unless there is ongoing growth in total factor productivity, then growth in real per capita income will eventually come to a stop. It's a model, in other words, that predicts economic growth will eventually cease. It will cease unless something else happens, and that something else will be an increase in total factor productivity. It very much throws the focus on total factor productivity and clarifies for us how without that growth in total factor productivity, there is an expectation, as you'll see, that growth in per capita income will eventually come to a halt. In other words, economic growth without growth in total factor productivity can never be a very long-run event. It has a finite lifespan. It's an incredible prediction. It raises all sorts of interesting questions. How can this be? And how can it be when we look at the historical record of so many economies, Western Europe, the United States, for example, that now have many hundreds of years' history of economic growth? But you'll see the key is in total factor productivity. The beauty of this model is that it highlights what is the absolutely essential factor that needs to occur for there to be long-run economic growth. So let's begin, and actually a lot of this will be familiar because we're going to build on many of the concepts that we touched on in our previous lecture. We'll be working, as is appropriate for a model of economic growth, with the per capita production function, which we illustrated diagrammatically in our previous lecture. We can also represent it mathematically. This is just shorthand notation, and if you think about it, what you're looking at there is really just a mathematical representation of the two-dimensional per capita production function we worked with in our last lecture. So on the left-hand side we have real per capita output for the economy, which we know is the same thing as real per capita income. On the right-hand side we have total factor productivity, represented by A, by the letter A, and a function of the capital labour ratio. So it's telling us what we discovered from our diagrammatic treatment of the per capita production function, that what matters for per capita income is the capital labour ratio and everything else that gets collected in that total factor productivity term. In addition, we're going to make an assumption. Again, it's something we've seen before. And again, we're just making this assumption for the purposes of simplicity. We don't need this assumption to outline the Solow-Swan approach to economic growth, but it's going to be easier to outline the approach if we make the assumption that everyone works. And if everyone works, then per capita output can be written as Y divided by L. L is the number of people working, but in this case the entire population works. And of course we can think of that as well as being a measure of average productivity. This is a model where average productivity is the key to growth, and as you'll see, in the long run, growth in total factor productivity is the means to achieve growth in average productivity. So here's a diagram that we have seen previously, the per capita production function diagrammatically now, where we have the capital labour ratio on the horizontal axis and per capita income or output or average productivity on the vertical axis. And again, let me emphasise, and this is actually going to be a very key part of the Solow-Swan story, please note that what we have built into this approach is diminishing marginal productivity. In this case, the diminishing marginal productivity of the capital labour ratio. And remember, and this is going to be absolutely key to understanding the logic of the Solow-Swan model, as the ratio of capital to labour increases, as there is more capital available per worker, the result will be an improvement in average productivity, an increase in the amount of output per person, an increase in per capita income, but that this occurs at a diminishing rate. And you're going to see very shortly just how important that notion of diminishing marginal productivity is to this particular way of thinking about economic growth. So far, everything I've described about the model is familiar. We'll now start introducing some new elements to think about. And the new elements arise because I want to ask the following question. Over time, what happens to the capital labour ratio? What I mean by this question is, suppose you just sat back and observed an economy over time. Is there anything over time that is going to happen to that capital labour ratio? Well, in fact, there are two important forces at work which over time will operate to lead to changes in the capital-labour ratio, and this happens without there being any intervention or indeed any decision-making going on in the economy. This is part of the nature of the capital-labour ratio itself. The first is population growth. An increase in the size of the population, which, remember, given our assumption that everybody works, means an increase in the size of the labour force. So we're going to use the letter L for our population, and all we're recording here is the tendency over time for populations to get larger. If that was the only thing going on in this economy, and for the purposes of this first observation, let's assume that that's the case. It's an economy where nothing else is happening other than growth in the population. Then the capital-labour ratio over time, as the population grows, must fall. Because we're not changing the capital stock, but we're growing the number of people using that capital stock. So over time, there's a natural inbuilt tendency for the capital-labour ratio to fall, assuming nothing else changes, brought about by population growth. There is a second factor at work, which over time will also lead to a fall in the capital-labour ratio, and this is depreciation. Now, by depreciation, what I'm referring to is the tendency for the capital stock to wear out through time simply because of use. In our notation, the way we can represent depreciation is there will be a fall in the capital stock, which means if that was the only thing that was occurring in the economy, we just sat back and observed an economy where the only thing that was going on through time was depreciation, we would be observing a fall in the capital-labour ratio. Now, in reality, these things probably happen simultaneously, but they both have the important implication that over time there are forces at work due to the nature of the capital-labour ratio implying that that ratio will diminish in value through time. For example, let's think about the following. Suppose, and I'm going to introduce some notation here, suppose we have a population growing at a particular rate, and I'm going to use the letter lowercase n as my shorthand notation for the population growth rate. Let's suppose that the population is growing at a rate of 1% a year, which we'll represent by the number 0.01. And let's suppose at the same time there is a depreciation rate, and I'll use the letter D to stand for the depreciation rate. Now, this is the proportion of the capital stock that wears out through use over a particular time period. Let's suppose that's 5%. Over a year, perhaps, 5% of the capital stock can be expected to wear out. What do these two factors, population growth and depreciation, imply for the capital-labour ratio? Well, let's do it this way. Depreciation means over this particular time period we can expect the capital stock to diminish by 5%. And over this particular time period, population growth implies that labour will increase by 1%. The combined effect of these two forces, depreciation and population growth, will be that over this time period we would expect that the capital-labour ratio will fall by 6%. let me now turn to investment. We've spoken about investment previously in our discussion of the national accounts and gross domestic product. What I want to think of now is investment very much as a flow of expenditure undertaken by firms, and its focus on their purchase of plant and equipment that adds to the capital stock. And I want to identify two distinct types of investment. First, replacement investment. As the slide indicates, when we speak about replacement investment, we're talking about firms undertaking expenditures by exactly the amount that will offset the combined forces of population growth and depreciation. The point about replacement investment is that it keeps the capital-labour ratio from falling. It doesn't grow the capital-labour ratio. All it does is exactly offset the combined effects of population growth and depreciation. So replacement investment is the investment undertaken by firms to ensure that the capital-labour ratio is not diminished over the course of a time period. The second type of investment is going to be called net investment. Net investment is any investment that takes place, any expenditure by firms on plant and equipment, in other words, over and above replacement investment. So you could think of net investment, and I'll use NI for net investment and RI for replacement investment. And if you just see me write the letter I on its own, that's total investment. Net investment will equal the difference between total investment that takes place and any replacement investment that takes place. The effect of net investment, if it occurs, and it doesn't necessarily have to occur, and we'll talk more about that very, very shortly, but the effect of net investment, if it occurs, is to grow the capital-labour ratio. Because if you're undergoing some net investment, you've already met your economy's replacement investment needs, you've already offset depreciation and population growth, and so this is expenditure over and above what's needed to keep the capital-labour ratio steady. This is expenditure that is actually leading to a growth in the amount of capital per person. So I'm going to write the following expression. Now again, this is just mathematical notation. This is just shorthand. It's just a convenient way of recording the discussion from the previous slide. Now everything from here on is in per capita terms. So on the left-hand side, when I write I divided by L, what I'm recording on the left-hand side is total investment. Often this is called total gross investment. Now I'm just going to write it like that. I'm not going to write per capita because it gets a bit redundant after a while. But be aware that what we're actually measuring on the left-hand side there is total gross investment on a per capita basis. On the right-hand side of the equal sign, we have our replacement investment. I'll just write INV for investment. Remember, the crucial thing about replacement investment is that it's designed to keep the ratio of capital to labour constant. It's offsetting population growth and depreciation. On the right-hand side, on the final term on the right-hand side, delta K on L, the change in the capital-labour ratio, that's our net investment on a per capita basis. Remember that net investment is the only thing that will actually lead to a change in the capital-labour ratio. So to remind us of that, to remind us that what net investment does is to change the capital-labour ratio in this expression here instead of writing net investment, NI, I'll write the effect that it has, which is to change the capital labour ratio. Now for a moment I want to focus on this replacement investment, because I want to think about it in a very, very particular way. And I'm going to start with the end point, in fact. What I'm going to argue is that we can write a very, very simple relationship between replacement investment and the capital labour ratio, where the amount of replacement investment that takes place over a period is equal to the sum of depreciation plus population growth multiplied by the capital labour ratio. The easiest way to think about what that expression is actually saying is to think about the following two situations. Suppose you have a given ratio of capital to labour. So think of that as the starting point. You start with a particular ratio of capital to labour. And we're just going to hold that fixed. Then if you think about it for a moment, you're going to need, for that given capital labour ratio, more replacement investment. So more replacement investment is needed if the depreciation rate and or the population growth rate is higher. So if you start off with a particular ratio of capital to labour, how much replacement investment you are then going to need is going to depend in a fundamental way on how fast the population is growing and on how quickly the capital is itself wearing out. The second observation I want to make about this is to think about the following exercise. Suppose you have given values of the population growth rate and the depreciation rate. Then, again, thinking about it logically, more replacement investment in that case will be needed the higher is the capital labour ratio. If you have more capital per person, then you're going to need more replacement investment for given rates of population growth and depreciation. Both those observations are consistent with this little equation here. For a given value of the capital labour ratio, the higher is depreciation and population growth, the more replacement investment is needed. For given depreciation and population growth, the higher is the capital labour ratio, the more replacement investment is needed. This little mathematical expression simply summarises the two possibilities that I've identified in the top part of this slide.